figure your story is pretty interesting, right? And especially because I don't think people really hear about it a lot. Like, there's a lot of people either think like stock investing doesn't work or like nobody can pick stocks, right? And then there's only a couple people that actually try to do it, but then you don't really hear about people who are successful at it.
Well, the
Like,
successful people get out.
yeah, exactly, right? So most of the successful people just don't even bother like communicating with anyone, I guess. So what's like your background?
Yeah, you already know about my nursing career, which is pretty short. But before that, I actually
Yeah.
worked as a tutor, freelance.
Oh, you worked a tutor.
Yeah. So I mean, if you look at like my CV, there's like what looks to be a big gap between my first bachelor's and my eventual nursing degree. And I was just like tutoring because I didn't become a
Okay.
nurse in 2015. I was 29 then. Like, so I had to look up my license just to see when I actually earned it because I could not
Okay.
remember. So I was a nurse in 2015. I retired 2 years ago now, 22. So I worked 7 years. My
You
life was active for 7 years, I guess I should say. So I had a completely non-finance, non-investing related career up until I became an investor. And up until I became an investor, my entire training and career had nothing to do with
was
investing.
nothing to do with investing.
Necessary, in my opinion.
Okay. All right. So yeah, so you had no background. What were you tutoring in?
Mostly math, some like him, did a lot of anatomy and physiology for the pre-meds.
Okay. Got it. Okay. So no financial background, maybe just a little bit of math.
Yeah.
Did you have any accounting background or anything like that?
So my first bachelor's degree was in theoretical mathematics. Far from accounting as you can get. I was like doing steps in sequence logic theory.
Right.
Yeah.
Okay. Why'd you go into medicine or nursing?
Um, well, the thing with math is you really need a terminal degree to do anything of note with it. I saw what the PhD track was doing to previous classmates. It just didn't
Yeah.
seem good use of my time or honestly money.
Okay.
Go through a terminal track, you spend maybe, let's say 80K inclusive of federal grants like programs, things like that. You get a job teaching at like a faculty somewhere, let's say maybe 80,000 plus benefits, all in
Okay.
25K. The math just didn't work out because you can walk out of nursing school on an accelerated track, which is like 1 year, and
Yeah.
make more than that.
Got it.
Yeah, it's just a pure numbers thing, which ultimately turned out to be a mistake, and it turned out I did not like the job.
Right.
So, but that's why I went into it. I literally just ran numbers. I was looking at pharmacy school, then like med track, and then nursing, and I realized that nursing gave the best kind of like bang for buck. If I liked the job, the eventual plan was to just finish out to become like a nurse anesthetist. That's like 250K a year on another like kind of internship. So that was the final goal, which is why my entire nursing career was pivoted so hard towards critical care, like ICU level. I hated it. It just did not work.
Why didn't you like it?
So when you're a nurse, you meet people who are kind of often at a low point in their lives, like they're sick, scared, and you have sympathy and empathy for that, of course. But meet a certain class of human being essentially has become a professional parasite on the healthcare system, have learned how to game the system so perfectly that they're basically using it as like tenant housing.
Oh, really?
So yeah, we have something called frequent flyers in healthcare. And sometimes the label gets applied unfairly to someone who has some kind of chronic issue with legitimate need, recurring like professional healthcare services. But there's also a class of patients who understand that if you walk into an emergency department in America and you say you have chest pain, no evidence that you actually have any chest pain,
Yeah.
treat it as a life-threatening medical emergency, then we have to at least let you come into ER triage. And from there, you can earn yourself a bed at least for a night because they have to run line. So you see how it happens? Like
Yeah.
you are completely wasting your time and you have no recourse against them, honestly. Where patients have like physically assaulted me and administration did about it. There was a time where I was accused of sexually molesting a patient, put on administrative leave with this whole investigation.
Oh, jeez.
Because I would not give them more narcotics than the doctor ordered. So it's like staying on their part. And of course I was found clean. There's no license action on my professional license. I didn't go to jail. Cops never even got called because the administrative review involved cameras. Everything in the hospital is recorded essentially. And they asked the patient, like, hey, just within a 2-hour window, can you tell us when you came into this? And they set a time, and the cameras clearly showed I was attending to another patient at the time, dead in the water. So, but yeah, just constantly running into the worst of humanity on top of good people who are just at their worst point. It erodes like your optimism, faith, the goodness of fellow beings. I just realized that I was becoming extremely jaded, and it's getting to the point where I was only acting empathetically out of a sense of professional obligation, or part of compassion towards fellow human beings.
Jeez.
Which,
Okay.
yeah, it got to that point. So I was like, dude, I need to get out, or this is going to ruin me as a person.
Jeez. Okay. That makes sense. Yeah. So it's like kind of weighing on your psyche. Um, it's funny actually. I've been on the reverse of that because I brought my mom to a hospital with like when she had chest pains, and I was actually like on the other side. I was like, oh, why is this taking so long, and why does she have to stay in the hospital? But I guess it's because of she was fine. So then, okay, so then you're like, okay, I don't like the job. How did you start to think about finance or stocks?
So fortunately for me, it wasn't like I fell out of love of nursing over a long period of time. I fell out of love with nursing in like a year. So the impetus was almost immediate. And do them, just track it out. There's a ton of like fire calculators, kind of a controversial topic. You can go into that if you want, but the calculators are useful in understanding essentially how long you'll have to work. So if you're not investing and your expected rate of return on the investment side of the calculator is always at zero, you have to work literally forever. Well, you have to work
Yeah.
until you're 60. And so that's not a future I want to live. I started to that, and I quickly realized after like maybe 10 minutes of playing with just a free fire calculator online that the most important input in that calculator is always your expected rate of return. How do I get this number to go up? Because even if I increase income and the percentage of the income that I save and put towards the investment, at a certain point, your rate of return just dwarfs everything. 15% CAGR at more pronounced as it grows in size, and But because I realized instead of focusing on finishing out my CRNA track and essentially doubling my income, it may actually have made more sense and would pay in a really long-term view, it would pay better if I just focused on learning. So first thought that I started this thing. And then I was actually learning to invest is not as straightforward as I think. At the time, I was very naive about it. I really thought I would just buckle down for a year and I would learn how to do it and everything would just be easy breezy the rest of the way. And that's not the case. And I know that, you're kind of championing that anyone can invest and do it. That people can beat the market if they know what they're doing. They apply their efforts in a productive way. At a time and effort just all over the place. No kidding. But I will say that I am personally of the opinion that the vast majority of people are just better off being a global vet and just doing those things.
Sure.
But not for a lack of ability. It's because active investing requires a very specific emotional and mental makeup over a long term without like just going bald from stress. So that's kind of my angle on that personally. I was not aware of any of this going in. I just thought it was
All right. So then you looked at the fire calculator and you basically like tweaked that percentage number and you're like, okay, what's going to change that year's number is just a higher percentage number. And you're like, okay, I just need to get that number higher. That was like, okay, got it. All right. So then how'd you go about, so then you're like, okay, I need to learn how to invest. Were you immediately like, I'm just going to start picking stocks?
Yes, that was a terrible. Like I said, I was definitely starting at the peak of the Dunning-Kruger curve where I thought it was easier than it was. And I thought I knew more than I did, which either one of those things independently will kill you, but both together is just exactly.
Well, you lost a lot of money immediately. Is that what happened?
Well, I started with a small amount, thankfully, not out of any prudence. I didn't think, oh, I'm only going to bet this amount because I'm not sure what I'm doing. I bet everything I had was not that much at the time. Maybe like 15,000, 10,000, somewhere in that range. So I didn't lose it all, but I lost most of it. I would say I was probably down to like less than 1,000. It was all just buying, getting emotional, all your hallmark mistakes. So basically selling at low, buying at a high, all that stuff. My takeaway from that actually was that I shouldn't be active investing and that I should just own it. I just went 100% into,
Okay.
which is, for listeners, just in case you don't know, that's the Vanguard. I would,
Hmm.
I was in that for quite a while, like 6 months, almost a year.
Okay.
What ended up happening there was I realized how long I was going to have to work, like the rate of return was not even inflation adjusted, just a straight 8-9%. I kind of lost patience, but I went back moving it back. So yeah, then
Got it.
really easy stuff. Like the first book I read that I remember reading was Phil Town.
Yep.
I don't remember the title, but
The number one thing, I think. Yeah.
yeah.
Yep.
But he basically he's like Buffett for babies. Like he's like value investing for one, like really dump it down,
Hmm.
which I think is not a place to end, but it's a great place to start. I read that, and then I also read Joel Greenblatt's Formula. It's not so much that idea or system attracted me. It was more that it provided like positive real world proof that you can beat the market without any kind of extraordinary talent or effort.
Hmm.
With a very simple, essentially 3 steps. So just having those two things in my mind were what I needed to really break away from like the wisdom of the crowd trap where everyone's screaming at you that you can't beat the market. You have to be in it front. You have to go for 20 or 30 longer to gain anything. And that's very difficult to do, I think, for investors. It's actually probably the primary aim to shake off for anyone who's trying to learn what you're teaching is that you have to believe, like really believe, not just like think maybe that it can be accomplished.
Yes.
Just take an unreasonable level of ability or knowledge to do it. So, but anyways, yeah, that's kind of where I started getting back into acting.
Okay. So it's like you saw that there is like an analytical way, which from the like either magic formula, and I haven't read the rule number one book, but I'm assuming it's like there is some component of valuation that can lead to returns and like return on investing or something like that.
Yeah.
Okay. All right. So then that was enough to get you to believe like, okay, I can do it.
It was enough to get me to think I messed up the first time, not because it's impossible, but because I didn't do a good job. So it wasn't that I put in a good, honest effort against what ultimately was an unreasonable test. More like I did not put a good against reason.
Got it. And it was what did you think was the reason for that? It's like it's because you were trading too much, or you're just making decisions that were not.
Honestly, it was 90%. I just thought my due diligence was when you start out as a new investor, there's no like benchmarking of this is what the due diligence looks like.
Mhm.
Well, the thesis looks like these are all the elements that are involved. These are things that don't matter. These are things that do matter. What you have is you just have a bunch of things like it. You have YouTubers like 3-minute videos on a stock pitch. You have a lot of elevator pitch type articles like on Value Investors Club. Really think what due diligence looks like. To understand the business, you have to run out numbers. You have to have a model, at least 1, 2, 2 or 3.
Yep.
There's a lot more involved. You don't realize how incomplete it is until the business blows up, the thesis blows up, something that you never saw coming. And if you have the emotional fortitude to make yourself post-mortem, really all there.
Got it. Okay. All right. So then you kind of got a sense of that. And I mean, that's already still like a pretty big hurdle, right? Like, because you're talking about like, okay, I need to run the numbers. How did you even figure that out?
So I will say that it is very helpful if you can. You have a brokerage that either gives you access to like sell side or buy side reports on them somewhere else, or maybe there's like a small shop that gives like a preview. But a lot of times what they'll do in the preview, and I'm sure that they'll just blur out the numbers on the forecast, but they'll show you'll see that you'll see what should be there in your own due diligence. If you look at your due diligence and the thesis you've written, and you realize that you don't have these numbers before, that's a big problem. So like that helps a lot. I think that's kind of where I started. But I would look at, I think it was Wells Fargo research that I had access to at the time was giving me free on some stock. I didn't care about the business. I didn't care about what the report was trying to sell me. I only cared about the format. Not okay. This is how professional analysts look at it. that they're trying to get to before they give a recommendation on buy something. So I pivoted at first to just make my thesis look like that, which was a good first, again, not a great place to end. I don't get very far past we stop. Because, I mean, I'm sure you know this, but in the world of finance, for those who don't know, all the money's in buy side. Meaning on sell side research, you are doing yourself tremendous disservice. You are taking the advice of the bottom 10%. Someone who's actually knows what they're doing and is good at their job will eventually find their, at least a mid-level desk. Even if they're not like a PM or something, they will still be working on the table. The PM is portfolio manager. Sorry, when I'm talking to, I'm like, yeah, I know, we get a lot. So that's why I really am trying to emphasize that it's only important as far as knowing what you should be calculating out to. Not important in terms of like, oh, like this is how I should be thinking business. In fact, I actually recommend ignoring as much of research as
you recommend. What?
I recommend ignoring as much of.
Oh, got it.
You know, just look at the formatting. That's it. Because you don't want to the way you think about something.
All right. Okay. So then you started looking at equity research. You're like, okay, so there's like a way to go about doing the numbers or like thinking about at least modeling the company. So then what was your like next step? How did you start teaching yourself that?
So basically I realized I do not know how to model anything. I did not understand my accounting was so weak that I couldn't even understand what some of the tables were. Like I didn't understand how they were getting to numbers that they were getting. That was a good wake-up call. So I went back to that, fixed all those gaps in knowledge, which is pretty straightforward. A lot of free resources on that cover it. Obviously, we can pay for a more in-depth or more bespoke approach that is handholding involved. I think that saves you a lot of time. More importantly, kind of guardrails you from mistakes. If you're trying to do it all on your own, like I did, you do make mistakes. You end up thinking certain things are more important than they are. Your accounting can have weaknesses built into it that you don't even realize. Because you're basically what you're doing is instead of just having someone teach you how to make it really yourself. I definitely don't recommend doing what I did. That is what and I basically got to the point where I hate to say this, I thought again that I knew more. Because I got to the point where I could build a model. Problem is just being able to build a model, build a good model.
Yeah.
Where I got to at that point, I would say, is that I could model out a business using the numbers the business itself.
Okay.
Which, as you know, is a terrible idea, but that's exactly what I was.
Okay. And so that's like from you. So you did some, YouTube, or you picked up some accounting courses, maybe. I guess you might have found some like basic modeling instructions of like how to build a model with the accounting.
Yeah.
Got it. And then you were like, okay, I'm going to use the historicals to start modeling the company. Okay. Got it. And then what happened after that?
Exactly what always happens, which is that historical performance is not always a good predictor of future performance. So what ended up happening there was that I was not adjusting the numbers at all. I was making no normalization for any of the actual economic and competitive realities the business faced. And as a result, returns were not great.
So what do you mean by adjustments? Do you mean like adjustments like taking out amortization, that kind of thing, or like just getting to the adjusted EPS, that kind of stuff?
Well, that part I actually was able to get to already, just because like even the free tutorials were like pretty that more that like, let's say just hypothetically, quick example, a business makes an acquisition.
Mm-hmm.
Acquisition is of such a scale that it could materially cause an inflection up in revenue or in margins. It's going to do something so that the immediate future of the business over the next 3 years or so is going to look very different from anything that happened prior.
Yeah.
Right. But if you're only driving by looking at historical numbers, well, you won't catch that.
Mm-hmm.
You'll get both to the up and down side. And like, that's kind of like the real issue. Like, that's like a really easy one to catch, but there's plenty of other examples where the business itself may look weaker than it really is, stronger than it really is. And the only way to correctly model it, or at least make what could be considered a defensible attempt to model it, is that you have to be looking at what exactly is happening with the business itself, and then first reflect what is actually happening. So like all the gap numbers, all the historical numbers, all that stuff, most of the time not that. You really need to be cutting things out or adding things in. that may not be allowed yet. Really should be. You want to know what to do.
Yeah. Okay. So then you're like, okay, I need to figure out like the drivers of the business and like, how do I actually model the performance of the business going forward? And that's, you have to like maybe not use certain numbers or like figure out what are they providing in their press releases and stuff like that.
Right, exactly.
Yeah. Got it. Okay. So then you pick that up. Did you just pick that up on your own? You're like, okay, my models aren't reflecting reality. Is that what happened?
Post-mortem, honestly. You look back over it and you realize like, oh, I thought this happened, this happened, and this did happen, but what I expected as a consequence of it did. Like what broke that causal chain? Like why didn't X result from Y? A lot of times you'll have it where the business is like, oh, we're going to acquire this and this one. Like, oh, great. They're going to realize all these synergies and all of this revenue is going to drop straight down to the bottom line. And then they report and none of that actually happened. You have to like go back and look. Again, I always recommend do not just take management numbers at face value.
Yes.
Then, you look back and you're like, oh, okay. So they were modeling in their projection, like a synergy that was always going to cut it down to at least something within throwing distance of what normally happens like that. Like really common sense things like that, when you realize that you always can see where the mistake was made. There was a mistake made that could have been fixed. Sometimes you just get blown up. But if you're really diligent about your postmortem, naturally be instructed over time by the market via your mistakes. They're different.
Got it. Okay. So like, as an example, it's probably like, say like, I've just looked at this company and they're like, they're maybe, I think they're like less than 100 million. And they're like, we're going to get to 500 million in 3 years. So then you were like, okay, let me put that into the model. And then a couple quarters later, they're like, barely even made 90 million. You're like, this is not going to work. That's what you mean?
Exactly that kind of thing.
Okay. Got it. And then by this point, did you get any like mentorship or any kind of help?
Because I still was not producing any kind of quality level work that anybody will merit would pay attention to. At that point, I was already posting on like Investor Club, like that. I was getting ideas from that site at the time. And the site was much higher. I would say, I don't think anything I wrote was worth anything was 10. I don't remember anyone reaching out right now.
Okay. Yeah. Okay. So at this point, you're like, you really started to focus on, let me get to a point where I can build like a proper model, like a good model that's reflective of potentially what's going on in the business. So then you were just getting better at modeling. You're trying to figure out the numbers. And then were you approaching your diligence differently at this point?
Yes. This is when I started actually trying to solicit calls.
Okay. Yeah.
The first time where I tried to do that, I didn't always get through it. Often I didn't, but it was very enlightening to be able to talk to your team. Or honestly, at the time you don't even get the CEO or CFO, just the IR guy.
Get the IR guy, yeah.
You talk to the IR guy first, but even just talking to the IR guy about like, oh, how are you seeing the business? Like, can you walk through this margin for me? Like, how are you guys getting this margin expansion or depression? Or like, what internally, what are your KPIs? That kind of thing. Landscape look like. So just getting that kind of color really kind of helps guide your thinking on what is or isn't likely to be a solid number, or how you should estimate, or what is bag. Like,
yeah. Okay. Got it. Okay. So yeah, at this point, you're kind of like being an equity research analyst. That's kind of similar to the work.
A very bad one, but yes.
And what kind of stocks were you looking at around this time?
At this time, I had already kind of switched over to small cap. Of course, it's the only way I was ever going to call this. But I was looking at a lot of like medical device companies because I no longer believe this to be the case. But at the time, I thought that fell inside my circle just because of I use these products day in and day out. Let me look at who makes them.
Yeah.
Big mistake. The other thing I was looking at was I was trying to really focus my attention anywhere I feel like the market did not like an industry, telecoms, anything to do with legacy broadcasting, anything that's cyclical in nature.
Yeah.
And just stuff like that where it's just not a sexy business, where even within like the C-suite, like the management talent in those industries tends to also be on the low end. If you're a good CEO, you probably just want a better business. A lot of times you will find whole industries that are just mired in like this animalistic, just irrational competitive landscape. Once in a while, you do find somebody in there has actual good management team. They can actually consolidate, roll up, and build like some kind of economically viable, like duopoly or triopoly out of there. Just fishing for stuff like that. I did okay. I'm starting to do better, which is probably the only reason I'm up. This is like the point where I was actually at the level where I could generate some amount of output consistently.
Okay.
Talking like I was happy if I generated like 300 basis points of output.
Yeah. Okay. So you were getting like 3-4% or 2-3% above the market. Okay. Well, this is actually pretty good. Like around that point,
Yeah.
but not what you wanted. And then I guess taking a step back, did you have a strategy at this point? Were you like looking for cheap stocks, or were you doing like the value kind of thing? Or were you just looking for things that are growing or just looked interesting?
So I would say the key question I always wanted both to be present and to be answered is I wanted to know what the market was. If I was looking at a business and the question didn't come up, what is the market missing? Why is it priced this way? What is happening here that the market is not seeing? If some version of that there, probably one, not really worth looking to.
Yeah.
If it's not answerable, you can't really make it a ton.
Right.
You find like 50 of those and you put like, 2% of your portfolio in each of those 50, eventually probably do okay. The single solo operator, you are going to be able to work on. I think. So you can't rely on that. You can't rely on statistical convergence and a medium level of due diligence.
Mm-hmm.
I believed and still believe that it's better to make large bets on high confidence stakes deep.
Mm-hmm. And then what were you doing to value companies?
So basically, you look at the business to date. So you have all the historical figures. You can look at historical figures for a lot of use, but like you're trying to normalize free cash, normalize growth capital. Want to look at actual organic growth, bolt-ons and things like that. Going into historical numbers, even a little often, you pretty good estimates for all that. If management is work on themselves. So you can use that to really help future, but also it gives you a good track record to look at if the management is trying to accomplish something is the answer to that question, which is like let's say this thesis is to date has been like a terrible low margin business that is always stuck with like vicissitudes of cyclicality, and it's trying to reduce that cycle and try to diversify its business lines. Well, it should have some sort of progress on that.
Mm-hmm.
On the ground floor, management's just saying, in which case you probably shouldn't. But you can look at past effort. And what's the rate of return on these? Test and fail rating. And more specifically, if you want to get even more, you can look at, are there any common characteristics of the initiative that succeeded versus failed? What is this management team good at? What are they bad at? So, because a lot of times you'll get people who are really good at stewarding or growing business organically, and just like they just swing the M&A bat and miss almost every time. The opposite, you get like these empire builders who are just great serial acquirers, but as soon as like interest rates go up or whatever reason the industry gets that tailwind or headwind, that dramatically changes the willingness of people to be sold or the ability to buy. Like, the business does what? Because like they can't do any magic business itself, right? Because that's not where their talent is. So, and like it's a rare animal that can do both. So if you have both, but usually don't find that. So it's just stuff like that where you really start to just develop a more accurate stats. Kind of like a BS detector when a management team, because they're always going to tell you something. But you can really kind of have a good sense of whether you should or shouldn't turn on this or that topic point.
Okay, so it sounds like you were looking at, say, maybe like an industrial company or a financial company that was just moving with the market, very cyclical, like you said, right? Just going into downturns and then coming back up. And then you noticed that some of them were saying, hey, we have these new strategic initiatives that are like, we have this new business line or whatever. And then you're like, okay, well, I can model out the returns that they're getting. And I'm assuming it sounds like you're going for a free cash flow type of valuation as well.
Usually it's either that or EBITDA, just to
got it.
Non-structured.
So then at this point, you kind of like started to get a groove. It seems like that you kind of knew what you're doing.
I thought I did.
Sort of.
We'll get to the point where I feel like I actually know enough to be like a credible investor. Again, I was not ready yet.
Okay, got it. All right. So I think so now we're probably going to get to the point where you're like, there's probably some kind of transformation, I guess.
So basically, what ended up happening was, how do I describe this? So I'm at the point now where I understand the importance of like fundamental analysis. Essentially, is what we're talking about, and not just fundamental analysis, but fundamental analysis that accurately, as much as possible, reflects the true economic reality of business. Right.
Okay.
One more piece, which this is the last thing I learned. The last piece is you have to be able to correctly assign subjective odds to the risk group.
Mm.
Like you can look at a business and let's say you have two businesses. The first one could double in 3 years. The second one could also double in 3 years. So main differentiator is going to be risk. And let's say the first one is running at break even on the way to growth and already is pumping out a decent amount of free cash flow. Obviously, in the second case, you have much better risk reward. So even if the first one, let's say, has like an 80% chance of getting the double and only a 20% chance of falling back to essentially a break business,
Yep.
the second one is more like 50-50.
Yeah.
Even though the math will tell you they're probably roughly equivalent, the 50-50 is better for two reasons. One, your capital is more likely to survive to be reinvested. But once you're down on total capital deployable, you need a greater amount of growth to get back to work. So losing 10% does not mean you get it back on 10%. And that's just how the math works out. And then the second thing is that most of the time you could be broadly right, but not precisely right. So maybe the business does double, but instead of 3 years, it's 5. And having some kind of free cash flow backstop allows them to do things like repurchase shares or pay down debt. Otherwise, essentially improve the investment over time.
Mm-hmm.
And actually really important. That's actually what saved me on one of my biggest investments, which we can get into if you want. But the big part of the thesis for me was that I thought there was going to be multiple expansion. Like the business would prove that it's a much higher quality business than the market thinks.
Yeah.
A 5 times free cash flow. I thought it would
Yep.
be easy. But the market held it at 5 times, like 5 to 6 times for going around 6 years now. And the only reason that investment has really worked is that because it's generating so much free cash every year, which is growing, it's essentially buying back like 10 to 50% of shares outstanding a year. Flipping that, essentially.
Yeah.
It's just understanding that when you look at risk, it can't just be, these are the odds that the idea doesn't work out. It needs to be a whole separate model where if it doesn't work out, I had not done the work on that. I was only looking at like a base case model, essentially. Like this is what I think. I didn't think about what if I'm wrong and the varying degrees of wrong. I mean, basically the takeaway here is that I underemphasized the importance of free cash flow in the event where the market does not respond.
Okay, cool. Yeah. So let's go into like an actual example. The one, it sounds like that you had an example where you, instead of just thinking about upside from your numbers or what your base case is, you started to think about what's like a downside scenario with free cash flow and what can happen, as well as an upside scenario, what can happen. And let's talk about like with an actual example.
Okay. So the investment I'm thinking about is called Nectar. The ticker is NXT.
Okay. And XSTA. Yep. Next star. Telecom company, I'm assuming.
It's a broadcast company.
Broadcast company. Okay.
You know, dinosaur, like cable TV kind of legacy broadcast. Automatically, you know, the market hates it.
Yep.
Really thought around it for a long time, since late 2000s, like 2007, 2006, like for GFC. DirecTV came out, DVD-R, like the ability to record TV. It's
TiVo?
I think it was DVD-R, I'm not sure. But that came out and people were like, okay, people can record live TV now and then skip commercials. You know, broadcast TV as a prime commercial ad market is there.
Yep.
So that was maybe the first multinational. The second one was the ascendancy of the internet.
Yep.
So like when ad spending is targeted customers, it's got better reach kind of thing. So it's been under pressure for a long time. For a lot of reasons that are immediately obvious to me.
Yeah.
But the truth was that there were a lot of things happening within the business, only at that business industry, more than offsetting that. But the first thing to know is that cable subscriber attrition is a very real thing. The market is not wrong about that. It is going down year over year at a significant plus. It's very easy to understand why the market hates it. But what was happening at Nexstar was they had done two things. One, they were acquiring an alarm. They were able to acquire, really this is the beauty of this, is basically what they're doing is acquire a station as a broadcaster. What normally happens is the advertising rates that that station was collecting, which it had negotiated on the strength of its scale at the time, those are honored through the end of the contract. Let's say acquire a station on a 3-year legacy ad contract. For 3 years, that's essentially a margin.
Yep.
But what they had invented was something called resetting the rate book, where as part of the acquisition, old rate structure is just thrown out.
Okay.
They're able to negotiate essentially a new contract on the spot at the rate that they're getting across their business at the largest broadcaster in America. It's significantly better.
Yep.
There's a lot of really obvious synergies in broadcasting where it's like adding a station adds almost no incremental cost because your content creation, feedback, and all that, it's all already going to just scale out the country. On top of that, it's just not that expensive to run broadcasting stations. Like your OpEx, your maintenance, CapEx, and your OpEx is not that much. Key asset, which is the broadcasting tower itself, the asset, almost never gets damaged except in the case of like extreme disaster, like a high magnitude earthquake or fire. So there's a lot to like in terms of that, in terms of just the resiliency of the infrastructure. But on top of that, because they can now acquire a station and then immediately have it jump up to the current economic strength of the actual business, what you're essentially doing is you're literally just expanding your business and earning back what you spent to acquire almost instantaneously. Because there's no period of digesting M&A, there's no period of synergy realization, there's no risk of execution on that. It just overnight. So because of that, they went from one broadcast station to the largest in the country. Now they can't even acquire another station unless they invest one because of like the federal communications. Like they rules on how much. So that was the first part. And the second part was that they invented something called retransmission fees, which is that to happen was you would create content like local or national news, and then other people would want to air it, and you would let them air it for free in exchange for a bit of admin. And what they started saying was that, hey, no, now on you pay us to air, and we get part of that. But they were the largest player by far, and all the other peers thankfully also realized that, hey, this is a good idea. We should also do this. It caused a sea change in the economics. And so because of that, they were able to actually earn more money. So the total size of the pie shrunk every year with, subscribers leave, but their share of that pie grew every year at a pace that allowed them to actually grow free cash flow for 10%. So that was kind of like the underlying thesis. The thought was that if they can continue to prove to do this, not over 5 years, 10 years or longer, maybe the market finally starts to give them something better than a 5x free cash flow. The side of the thesis that didn't work out still has not worked out. They're still there.
Right.
But since I bought that company, despite the fact that the market has never given better than I think at its peak, 7x free cash flow, I've 30x my money on that investment.
Oh, wow.
Yeah, just because the company, one, is growing, like I said, and they're able to grow quickly because they can, all their M&A acquired debt is just, and then two, they're buying back shares just same pace. So on share repurchase alone, you would already be alpha. But then the company is growing on top of that. Like you have actual M&A growth, then some amount of organic growth, share repurchases. There's also a dividend, which is like 5%. And you throw that all in and you're like easily getting close to 30% CAGR.
Wow.
At a time. So it's pretty insane. And then, there's a bunch more to the business. Like, I don't want to turn this into like a stock pitch.
Right.
I won't go too far into it, but basically that was the important part there was that the main reason for my investment time was not that I thought business would be able to 30x without multiple expansion. My
Mm-hmm.
whole was on expansion.
Mm.
So my thesis was completely wrong. In terms of the base case thesis, it should be considered a failed thesis, but it's
Yes.
not a failed investment because the downside saved me.
Okay.
Really what it was. And living through that and watching a thesis just crumble around me, and yet the position is money over time. I was just like, what is happening here?
Yeah. Yeah. Yeah.
So I was like, oh, okay. So I should really, if I can get this in another idea, I should really prioritize this element as much as possible.
The downside thinking.
And like just having
Okay.
a bit that can survive long-term neglect by the market by taking advantage of it. And you can only really do that through aggressive share repurchases if you.
Yeah. Okay. Got it. Okay. So just like a recap of this is like a 5 times legacy broadcast company. It sounds like there's some new management that's like has a new strategy of it's like a roll up strategy. We're going to acquire these new stations. But when we acquire these new stations, we get this new content, but we can raise the prices. So it's immediately accretive, meaning it's a boost to our free cash flow, even if we're using debt. We can pay down our debt to pay it down. And we're already getting, and then with the acquisitions, we're getting like a 10% CAGR. But then because there's not many reinvestment needs or OpEx, like you said, and if the market's not rewarding us, we can just give it back to shareholders or just repurchase stock. So then that 10% plus like the 5 yield plus like 5% a year in share purchases just boosts everything up.
Yeah.
Is that kind of what happened? Okay.
But yeah. So the thesis didn't work. The investment did. It was a good lesson in how you can own a thesis. Like you can own a business where the entire range of possible outcomes outside of like a black swan event result
Yeah.
in you can
Got
make an
it.
event where the downside is still.
Okay. So then you started to think like, okay, I need to start also thinking about scenarios. All that, like I'm fine.
Basically, I guess I would say that now that I'm talking it out, the real takeaway was just that the level of quality that I demanded from an investment idea skyrocketed after that. Now I didn't want to be long in anything where I didn't feel like even losing would provide alpha. So
Got it.
like maybe not as much as I want, but it won't be like I lose money on it.
Yeah. 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 I think okay, that's interesting because I think I had a similar realization with like a stock I covered. It was similar kind of story, but more of a growth company. It was actually a growth company. And, like I did the research and it was like MSCI. I thought like, okay, there's I can't really think of any ways that even if there's a downside that they would lose really that much business. But like similar, they had so much free cash flow that they just started raising a little bit of debt. So they changed their shareholder to more equity or to more debt. So it increased the returns on capital and they just repurchased shares and they had dividends. The same way it went from like a 10, 15% earnings growth to like a 30% CAGR. Okay. That's awesome. So then that was like a big turning point for you.
Yeah, that's how I basically got to the lifetime CAGR that I'm at today, which is probably still not sustainable, but it will be higher than if I hadn't learned this lesson, which is just that it's fine to own like 5 stocks or less. Like there's a lot of times on 3, 2. At first it's scary when like half your net worth is in one business. You've really done the work and you're really confident in your work. And you know that the downside is you're only up 12% a year instead of 6% a year. Like,
Yeah.
it's okay. Like people get really skittish when they hear about concentrated investing.
Mm-hmm.
But yes, if your hurdle rate on your ideas, inclusive of the whole spectrum of plausible outcomes, is high enough, it allows you to be that concentrated without any real risk of blow up outside of like totally.
Yeah. Got it. So I guess it's not to put words in your mouth, but it's almost like now you're thinking in scenarios and you're still thinking about it. Well, now you're starting to think about the probabilities, but then now you're thinking about odds in the sense of, okay, even the downside, I can have a positive expected value, even adjusting my probability to the potential scenario. And then you started to weight your investments to those type of situation. And then I guess I'm assuming that's when your CAGR just really went up a lot.
Yeah, you're more than double after I started doing that.
That's awesome. Okay. And so I guess at this point, this must have been around the time where you really boosted your returns and you got to your final goal, which is, I don't need to do this job anymore.
That final goal was the COVID crash, but yes.
Okay. Got it. So you had I think you were telling me like Accor or something. So you had another, was that it? You had another investment that's like similar like that?
So I was looking at industrial cyclicals because I knew the industry overall was pretty unloved, like about production suppliers, like manufacturers, because it kind of goes as the economy goes. If
Yeah.
your new construction starts are healthy, your business is healthy, and if it's not, it's not. But there was Tyco, which you may be familiar with. It's a pretty big
Hmm.
one. They own this like infrastructure play called Accor that was spun out of Tyco when Clayton Dubilier Rice and the PE firm bought their stake. So that's
Hmm.
spun out 15, and CDR is a very reputable PE firm. They know what they're doing.
Yeah.
They put in a CEO who was a senior vice president at Danaher.
Yeah. Yeah.
Right. He started implementing like the Danaher business system, called it the Accor business system, but it really wasn't anything. So
Hmm.
from the day one, he had a chance to essentially clone Danaher into this small, terrible business at the time. Just not worth owning at all for any reason. But over time, he divested all the terrible business segments by rolling up the ones he thought could be good. And he, over time, positioned the business where he was only operating in segments in which he was part of a duopoly or a triopoly
Mm.
with good peers who understood how to raise prices together, move prices together, just really good, healthy, competitive environment. And then on top of that, he did it in a manner where all those like oligopoly competitors were competing against Accor, but Accor was only competing against one competitor. So the
Mm.
key advantage there is that the construction guys are going to need different products. So why cut a deal with the competitor who can only deliver, let's say, PVC piping when you need like 5 different SKUs that Accor can all deliver in like
Mm.
one order, one receipt, one delivery, highly reliable. And so I was thinking that they could really build a book here. Like their input costs are going to be lower. They're the only operator of scale across several adjacent industries. They have vertical integration through like their service centers,
Hmm.
delivery fleet. They're highly reliable. Their average shipping model is already the lowest. They're expanding their geographic footprint, which cuts shipping time even more, which is a huge advantage in terms of not just customer experience, but cost, because most of the construction equipment they make is quite bulky.
Hmm.
I think about like a 80 or 100-foot segment of PVC pipe, and you're shipping it on like a flatbed truck, 100 miles down the highway. You're mostly just shipping air. That's what you're doing.
Right.
So your shipping cost as a part of that low price commodity shipment is pretty substantial in terms of margin. So having
Yeah.
to ship miles is actually a big deal. It's quite a bit of margin on the back end. It's just realizing all these things where it's like, okay, even though everything they're doing is essentially just running a business as soon as possible and whatnot, because of the nature of the economics of the business they're in, it actually constitutes them. Because
Mm.
if they did this before anyone else, nobody else can get to kind of. So the
Got
huge
it.
mover advantage potential. And I really thought they could do it, but the market also had caught on because I
Yeah.
came to the idea late. So by the time I was starting to buy the business, it was already at like a mid-teens like PE ratio.
Yeah.
The risk reward is okay. It's not amazing. It's okay. But the business was obviously just gushing free cash flow, tons of earnings everywhere. So I felt comfortable. I can wait for
Yeah.
that. But then the COVID crash happened, like literally like 6 months after I started buying it.
Yeah.
And the PE ratio went from like 13 to like 5.
Right.
I was like, okay, sell everything by this. That's exactly what I did. So
Yeah.
I sold at the bottom on a lot of stuff, which I was acceptable with me. So thankfully I was at a point in my investing career where I had the intelligence and the emotional fortitude to do that.
Yeah.
Looking at Floyd that's deeply in the red, I'm just like sell like
Yeah.
half my, buy this. So I pivoted. Accor at the time was a 4% position and made it 40%.
Yeah.
And then on the other side, and this was another happy coincidence, I did not predict this at all, is that the COVID supply chain impact just
Mm.
crushed competitors. And Accor was the only one who had enough purchasing power, enough supply chain resiliency, enough logistical investment to continue to deliver to these customers during a COVID supply chain crisis. They were able to like essentially double prices overnight.
Mm.
And yeah, it was crazy. Like the supply demand dynamics just completely inverted.
Yeah.
So what was supposed to be like a massive hit to the entire industry turned out to be the biggest windfall.
Huh?
So they came out beautifully through that. And great thing about that business is that everyone thinks that their tremendous run is thanks to the windfall. Like they're like, oh yeah, but once demand normalizes, they're gonna go right back to being some terrible commodity supplier. Like, no, there's no reason to own this.
Right.
They don't see that. And this is hilarious to me because the market was pricing it like it was better than that already.
Yeah.
They don't see that the growth was there before. They were
Got
had a
it.
20% EBITDA CAGR before the windfall.
Mm.
And they were at like a 40 or 50%, something totally ridiculous during the windfall. They don't realize that at the other end of this, they're still just going to resume that 20%.
Got it.
So it's been amazing. I've had several more opportunities to add to the position, 7 or 8 times earnings.
Yeah.
And I'm talking 7 to 8 times normalized earnings, not windfall.
Oh,
It's
wow.
like 2 or 3 times windfall. So like the
Wow.
market has no faith whatsoever in business. It just,
Yeah. Yeah.
on balance, it has been my biggest winner in terms of just actual total dollars return.
Yeah.
But it's because I had a chance to buy a quality business, times earning, that is just crazy irrational.
Yeah. Awesome. And that one turned into like a 30-40% type of return for you or even higher.
We actually looked it up. So my lowest price paid for Actor was $11.85.
Yeah.
And right now, that was in 2020.
Mm-hmm.
Yeah, that's like right around now is when COVID crashed. Basically, almost exactly 4 years later, the stock is at 175.
Yeah. That's awesome.
Around that is probably like 75%.
Yeah. Wow. Got it. That's cool. So you were also like understanding like they had a strategic advantage, like positioning in specific markets. You figured out they had like some sort of sounds like a cost advantage in their supply chain or operations.
And then, it's all that's able to play out because every single SKU, every product that Accor sells combined, like the total amount of the products that would be needed to complete a project only
Yeah.
makes maybe like 5 to 7% of the project budget.
Okay.
This isn't an area where customers are looking to like really cost contain.
Keep cost contained. Yeah. They're like a small widget. Yeah.
Right. And the problem is that like it's stuff like PVC pipe, which is kind of a nothing thing in terms of price. If you have your construction crew show up and the PVC pipe is not there, they cannot lay the bricks, cannot build the walls. They have to wait.
Yeah.
They can do it later. Entire project, there's a multi-million-dollar like data center projects that are being put off pace, off schedule, because competitors cannot something simple like conduit or PVC pipe their time. But people are like, I will pay Accor 2% more to make sure
Yeah.
thing. It's definitely worth it because I don't know if you know this, but in terms of non-residential construction, the biggest constraint is labor. Nobody has an excuse to get stuff done. So anything that protects your labor efficiency is well worth it. Like the other side of it, where people are like, nobody's going to want to pay a premium for PVC pipe. It's like, well, you talk to them, they do. They'd be happy to.
Right.
Begging to. If
You don't want to delay
delivery, yeah, for sure they'll pay it. So
yeah.
Really happy with the company, the way it's run. I think the management's great. Right now they're pivoting into another project line or product line, just like solar torque tubes, because the Inflation Reduction is like pitching like domesticating essentially supply chains.
Mm-hmm.
So if you buy American, we'll give you a tax credit and all that stuff. So basically, management is aware of the industry. They know what's happening. They always.
Yeah.
Very overall.
And when you found all this information, were you doing something differently or is this kind of the same way you were doing it before, like reading filings, talking to management?
I was reading filings and I was talking to management, but I think the big difference there was I was really making an effort to expand my due diligence to include like peer pumps.
Mm-hmm.
Well, they got acquired. They had one major competitor in a major business segment called Wire, Encore Wire.
Yeah.
It was IRE. They were recently bought out. But when you talk to them and you listen to how their management is talking about market opportunity and the moves that they're making, it gives you some context, some extra frame preference. I wasn't doing that before because what would end up happening before was that I would just look at filing or earnings call transcripts for peer comps. And then I would pick what I'd like the best out of those and then only really talk together.
Yeah.
But taking the time and like really adding in that extra layer of work, I think is because it lets you know when somebody essentially doesn't know what they're talking about.
Yeah. It's like a check so you understand the whole kind of landscape because you're talking to all the peers.
Right. I'm talking to 5 CEOs who are all in the same space and 4 that were saying this and one guy's saying something different.
Yeah.
Like, all right, he's the crazy one.
Got it. Cool. All right. So I think at this point, I think this was like you retired. This is like,
I worked for 2 years after this and I hung it up.
yeah.
I'm not doing this anymore because after 1 year, I didn't need the money, honestly. I hung in there one more year just because I had this fear that the whole market would crash or that my ideas weren't going to work out. Or I don't know. I just didn't have the guts to really trust my work and portfolio help off entirely. Because nursing is a career where if you have any kind of gap, it becomes a problem, real problem.
Mm-hmm.
People think you've lost your skills, that you haven't kept up with your professional education.
Yeah.
Most people don't want to hire you if you have a pretty big gap in your work history. I knew that cutting ties, you probably meant walking away forever. It took a while for me to get comfortable, to be honest. But
Okay.
yeah.
But eventually you did.
Oh yeah, 2022. I you were like early 2022. I was like, I'm putting my 2 weeks. Yeah.
How do you feel now after going through this journey?
Pretty good. I'm always cognizant of how much luck was involved. Really,
Sure.
like, I'm not saying that I couldn't do this again. I probably could, but instead of doing it in 6 years, probably more like 10. Because like
You had a couple wins.
like how many times are you gonna have your sights on a company that essentially goes down 70% in like 2 weeks for no reason?
Right.
Like,
Right.
how often is it gonna happen, really? So,
Yeah.
I think that essentially time warped me 2 years worth of returns ahead.
Yeah.
Big thing, and then some of it's luck in that I made so many mistakes, but I made them when I was.
Right.
So it was like actual dollar impact was pretty small.
Yeah.
Losing $5,000 or $6,000 at the time feels huge, but making that back is very doable when your portfolio is like 7, 8 figures. So
Yeah.
good day, like not even for lunch. So
Right.
I'm not saying I'm making that before lunch every day, but like the portfolio as a whole
Yeah.
moves up quite a bit in terms of absolute dollar amount. But it's just things just worked out pretty optimally in my case. But that
Yeah.
it requires that level of optimization to work overall. It would just require more time, I think.
Just a little bit more time. Well, you were prepared
Yeah, I was
to
prepared
recognize the opportunities.
for sure. But I should say that I picked up the mentorship around the next start point.
Oh, okay. Yeah.
Wrote on Value Investors Club where someone messaged me and was like, "Hey, it's actually the most compelling argument I read on owning this terrible business." And I was like, "Trust me, it's not terrible. Let me walk through it." And like the whole time, this guy presented himself as like just Joe Schmo. Like, oh, I'm another retail guy. I just want to hear thoughts, kind of thing. He asked questions in a way that didn't really tip me off, right? Or I just wasn't smart to pick up on it. It turned out the guy ran pretty sizable fund. I think at the time it was like 400 million AUM.
Oh, nice.
And yeah, and it's just like a small shop at the time, but yeah, attracted quite a bit. It's like one of those funds where you buy in and your funds are locked for 3 years.
Mm-hmm.
Can't take anything out. And usually at the end of 3 years, people are happy enough that they stay in. But he basically walked me through like what he saw as the big mistakes in that thesis. And there were some. But after that, he introduced me. Well, first he pitched me a couple ideas like, "Hey, what do you think on these?" So I sent him back my thoughts on those. Then he introduced me to someone else who would also give me an idea. And so you know how it goes. Like you kind of have a network of people who respect your input and then also you respect their input. Kind of
Yep.
like,
Yeah.
comes like your first filter, maybe like this.
Yeah.
Because we're all looking, but we're all probably going to find one good year.
Yeah. Right.
It helps to have extra people on.
Yeah. Do you still talk to him or were you talking to him and the others on a regular basis?
I talked to him this morning.
Oh, really nice.
We're all three of us are long. One stock that we all believe in. It's a number one position for all of us. But
Yeah.
we're talking some relevant news that came up. We're kind of just chewing on it together. But
Yeah.
I
Awesome.
would say over the last 3 years, all of my ideas either been from me or from this.
Oh, really? Okay. You guys like have a sort of like a shared idea kind of exchange kind of group.
Anytime one of us finds something that we think could be good, it's become tradition to just bring it up.
Yep.
Everyone start kind of chewing on it if they want, if they have the bandwidth. Sometimes they don't.
Yeah.
Sometimes chasing your own best idea kind of thing, really distract yourself.
Yeah.
It's good. And it's also a good sanity check because there have been times where I'm really excited, like, really think it could be a winner. Like,
Yeah,
no, absolutely. Garbage ideas. Yeah.
that's funny.
I'm missing something big here. Or,
Yeah,
uh,
yeah,
it kind of saves you sometimes. But, yeah, I think it's, if you can create that kind of, I mean, yeah, I got lucky in terms of like actually having professionals in my corner. But
yeah,
even if you other retail guys that you think know what they're doing and know what they're talking about, I think having a very selected, curated peer review board of your own creation might help.
yeah, yeah, for sure. You get good feedback
Yeah.
on the ideas and your thinking. Yeah, I think it's important. Cool. Any advice you would share for someone who's kind of starting out or is interested in investing, stock investing specifically?
I would say that if you start analyzing a business and you really just hate it, it's like pulling teeth,
Yeah,
give it a little bit and maybe 'cause sometimes people find joy in excellence kind of thing. It's
yeah,
like at the beginning it sucks because you suck, but at the end when you actually know what you do, you feel great about it.
yeah.
I would say give yourself to that. But if at that point you're still just like, I dread going through 10Ks,
Mm,
fine. Like just hang it up. Like it's okay. Just you can focus your efforts elsewhere. Like start a side hustle, find some more income, increase your
yeah,
savings, work on the other levers you have towards some
yeah,
financial wealth. And don't force yourself to do the thing that even if yeah, it's the most efficient, if you hate it, so what? You know? But that's the
yeah,
exact mistake I made with nursing. I went for the most efficient lever career wise and I hated it. Not even in it anymore. Like why?
yeah, 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 yeah.
So, like, understand that it's just not for everyone. If it's not for you, that's okay because there are a ton of other things you can do to get to where you want to be financially. It doesn't have
Yeah.
to be. But if you do love it, yeah, you got good stuff ahead of you if you keep with the other thing, the big one is that the wisdom of the crowd is a real majority opinion tends to be the correct one. A
Hmm.
margin of people usually can outperform the expert. But the you have to be able to form your own opinion on whether you agree or disagree with the crowd on everything.
Hmm.
And
Hmm.
that's integral to investing because
Yeah.
the market will always give you their opinion real time in your face, dollars and cents, red and
Yeah.
green across the portfolio. And you gotta be able to withstand that constant disagreement of opinion.
Yeah.
If you can't do that, it's gonna be rough, man. I don't know. Maybe just like glue once a year and then let it go.
Yeah. Yeah. Yeah.
That's my big thing is that, even though I obviously fully support what you're doing, I think there's definitely a large number of people who could benefit tremendously from that kind of thing, product that you're offering. But, it's still not for everyone, right? Like, there are people who are just curious,
Totally.
focusing on things. So that's the main two things. Like, don't try to be a square, forcing yourself into a round hole.
Yeah. Yeah. No, totally. Yeah. I mean, I think it's, I think about my journey similar. It's like, yeah, like when I first read 10K, I was like, this is the most boring thing I've ever read. But then you just stick to it. And it's actually kind of interesting after a while. Models are like ridiculous after a while. But then like after a while, it's like, it's kind of fun to try to figure out a business. Um,
Well, at some point, you reach the level of competence where the numbers start telling you a story. You're
yes.
reading through an income statement or a balance sheet, or you're reading through, anything on the 10K, honestly. And you
Yeah.
just start to construct this narrative in your head and
Yeah.
every read just adds 1% to the story. And it's like, it becomes very interesting.
I
But
think
at an
so.
entry
Yeah.
level, it is just a ton of overwhelming information. And
Yes. Yes. Got it. Okay. Yeah. I like that. Yeah. And then of course you got to have your own opinion. I think that is, it's very difficult if you can't, if you don't want to, or like you kind of need to, if you're going to be picking your own investments.
you got to be a little stubborn and a little crazy. You got to really, even if the market says you're wrong for 6 years, you got to believe it. So
Yeah.
as long as
That's
you have
good fortitude.
yeah, those, I'm not saying be stubborn to be stubborn, but if the fundamentals and the business performance, the numbers they're reporting all tell you you're right, don't let
Yeah.
the price tell you you're wrong.
Right. Yeah. Yeah.
There's
Yeah.
also true. If the numbers are terrible, but the price says you're right, you're still wrong. Get out. Beautiful. Get out while you can. The market's giving you a beautiful, like, get out.
Yeah. That's an important thing too. Yeah. Even if the market's giving you a great price, if you're wrong on your thesis, you should probably still get out. Unless you're wrong on it, unless you're right on the downside, of course, like in your case, and you're making, uh, cool. Anything you would do differently? thinking back?
Mm, I think the biggest mistake I made was that I tried to like hurdle over 6 foot fences instead of 1 foot fences. Like that was the main thing. If you're patient and you're willing to just keep grinding, the good ideas are obvious. They really are. We'll get to a business and you're like, okay, I would say, ballpark this should probably be worth $100. The
Hmm.
price is $7. And you're like, oh, I can be really wrong here and still make a lot of money.
Yeah.
So like, yeah, I always found an idea of like, I would find a business and the business itself is sexy, has good margins or something. Like product. I don't know. Something about it is just intuitively attractive. And then you just try to force yourself to understand them well enough.
Yeah.
It's like, yeah, it could be a good investment. And like, if it, it's just not excellent risk reward. It's okay kind of thing. Was to let those ones go. Just throw those back and just wait for the right pitch kind of thing. There's no call strikes. There's nothing nice to say.
Yep.
So it was really just learning that a key lesson where you can be in cash. If cash is your best idea, it's your best idea. Like just sit on cash, keep reading 10Ks, keep listening to calls, keep digging.
Yeah.
It might take you 10 months before you can turn that cash into something good, but it's better to do that than to have the cash in a bunch of stuff that's just
Yeah. 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 Like
that
just
helps
keep
you.
doing the reps, keep studying businesses, keep thinking about the value, and then like something will emerge, but you don't have to force yourself to.
I haven't bought a new business in 2022. I'm like,
Oh, wow.
oh, that totally.
Yeah. 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 That's good. Cool. Fun plans for retirement. What do you get? What do you got? What are you up to now?
So I recently purchased a pretty decent parcel of land, like 70 something acres. It's like an hour outside of, Denver. So
Okay.
the idea is that I need to get crew out there, do a survey and all that, and like need to pass some like wildlife ecological surveying permit thing where I have
Yeah.
to do what they won't like irreparably damage the ecosystem.
Yeah.
After that part's done, and I know what parts I can build out, what parts I can't, kind of thing. I want to kind of build out like a nice little compound out there.
Oh, cool.
But I've been living in fair-sized cities my entire life, and I've done a pretty good amount of traveling, and I realized that in my travels, the places I enjoy the most are always the places with the least people. Sometimes that's like taking over from nursing, and there's like some misanthropy that developed there. But yeah, I have realized that my ideal retirement probably is not in a major city.
Yeah.
I'm not huge, just like mid-size.
Yeah.
Yeah, I do think that I will enjoy my time out
Okay. So it's like for yourself, you bought a piece of land and you're going to develop a house just for yourself. Got it.
there. Well, it'll be a house, and then there'll be like a separate guest house,
Yeah.
and then just so like because people want to stay, there's no hotels anywhere close, so
Yeah. Yeah. Yeah.
things like that. I figure it could be fun. It'd be fun to try some stuff. Maybe get like a greenhouse out there, or like
Oh,
a
cool.
pork shop or something. Like
Yeah.
if I can.
Yeah. Yeah.
And, fortunately, I'm blessed enough to have this kind of experiment. So
Yeah.
scenario, if I just have to replant trees and take the cleaner tax credit, I'll just put that land out there for whenever, however long. Like, fine. Like I'm totally fine with that. So if it
That's
doesn't
cool.
work. Yeah. I can always sell it at the main plan, but honestly, I'm still enjoying investing. I honestly, my original plan was once I got to this point, I was supposed to sell all individual holdings, like opportunistically over time,
Yeah.
before we move into a totally passive approach. I did like a bond ladder going, and then, although thank God I didn't do that, but
Think I
actually
didn't.
bonds kind of went.
Oh, yeah. If you went into bonds after you
Yeah.
got out, yeah, you would have been back to active investing. I need to do this again.
Yeah, no, I didn't ladder it to any bonds. I didn't do anything, but I was gonna ladder it to like 15% bond, enough of a bond allocation where the interest was supposed to meet my core living expense. And
Yep.
then everything else just into like, or
Yeah.
everything is like triple Q or something.
Right.
But I never did because it just didn't seem fun. And so I stuck with it.
Mm.
And now my latest idea looks like it could be the best one ever.
Oh.
I don't think I need more money, but I won't say no. Just because I have nieces and nephews. I don't have any kids of my own, but I have nieces and nephews. And
Yeah.
I do think my generation or the people investing now are kind of getting the last hurrah of the market as we know it. The reason why I'm able to carve out an advantage at all is because there is an ignored part of the market where not much talent or effort is brought to. just because nothing can be actionable for structural. Like if you're like Goldman Sachs and you find like a tremendous small cap, can 100x in 10 years, who cares? Your client list
Yeah.
cannot, just
Yeah.
cannot.
Yeah.
So it's like nobody's going to put their best equity analysts on it. In fact, they're not going to put any equity analysts on it. The only people
Yeah.
coming from like these bespoke, like small cap focused, like
Sure. Yeah. Yeah. Yeah.
so it's like, yeah, they might have like their intern do like something like a small cap or small cap top 10 pick list or whatever. But like that's
Yeah.
not going to go. So that advantage only exists because human capital is still powering price discovery of the market overall. In my opinion,
Yeah.
it's totally just me speculating here, but
Sure.
like how like trading got taken over by AI and like how it's down to like processor cycle. That's how tight it is. It's like how far you are from the New York Stock Exchange in terms of lead. All these things.
Yes. High frequency trading. Yeah.
Right. So there's no reason why at some point machines and AI cannot do that with equities overall, in my opinion. I think they will get to a point where maybe the absolute cream of the crop, Warren Buffett's of the world can still beat it. But I don't know. I'm pessimistic on that even, honestly.
What makes you think that?
I read an article on Medium about somebody talking about, is your job AI proof?
Mhm.
He was through it and he's basically like, okay, is the human to human contact really crucial stuff for investing? To the other side of it is that how much of your job relies on intuition? And I realized very little does. When a properly crafted thesis where the modes are proper modes, by which I mean they're structural. It's not key man risk. It's not like some investment. It's not a patent that's going to just fall off patent 10 years from now. There's deep seated, irreproducible, unchallengeable structural reasons. Business is just invincible. A black swan. All that is evidence in numbers can be correctly interpreted by a machine. And so, because, it's not that hard. Like you look at margins, you look at input costs, look at what they're selling for, look at how they do.
Yeah.
The pressure is just very evident. So when I look at that and I think about how a machine can, like an AI could read through all 4,000 or 5,000 stocks that are listed and do it instantly with no real extra effort, why wouldn't the hypothesis of the efficient market come to pass? And if it does come to pass in any kind of meaningful capacity, I'm not saying it'll ever be 100% perfect. Let's say it's just 90% perfect or even 80% perfect. You said that an investor like me could act on in that environment is so small as to be almost impossible. Because even with the entire market open to me in terms of small caps, it's still one idea a year.
Right.
It was only 20% of those small caps. And I don't know which one either.
Yeah.
Right? Like, I don't know. I feel like I'm at the point where I'm pretty convinced that because my niece is 3 and my nephew's 4, by the time they're adults and at an age where they would likely be investing, so let's say early 20s,
right?
What kind of market they're going to have? I don't think they'll have the opportunity. So I feel like I should probably just go ahead and try to make money now. Capital markets will still exist. I'm not saying anything crazy like that. That market will still be there. But
yeah,
in terms of somebody like me coming from nothing, achieving almost a 40% CAGR, that's probably over and done with in 20 years or so. So at the very least, I do not think that the possibility of that coming to pass is something that you can just hand wave. I don't think it's fanciful. I don't think it's near zero. I think there is a very real reason because there's tremendous economic incentive to make it happen. Because the first person to crack that code and get an AI that can, even within just one industry, like let's say they understand like pharmaceuticals. So what? Like, okay, great. There's someone else makes one. Like it could be like a chimera of like that are all hyper focused and hyper good at one thing.
Yeah.
At net effect, they will take the market away faster. Different things. So
I kind of see that. More in the sense of like someone who has the ability to see these type of stocks, but then they're able to leverage like machine learning or AI to be able to find them. That it's like you can leverage yourself to like be 100 times yourself.
Right. And that version of it also creates the same problem, right? Realistically, it's the same issues. Even if it
it would be the same effect. Yes. Yeah, you would take away the alpha from everyone else.
My main concern is how easy is alpha going to find? Because I would say right now it's actually pretty. If you know where to look.
Yeah. I mean, even in like large caps, I thought it wasn't that hard once you know what you're looking for. There were like for whatever reason, the market is efficient, but it's not efficient like 5 years down the line. Like it's not like everything has gone down to the whack, like the 8 to 10% return on capital. It seems like you can still just buy Visa and still make more than 10% every year.
Yeah, I mean, yeah, if you're just trying to beat the market by, let's say, 50%, and not 50% of actual alpha, I'm talking like 50% over market return.
Yeah, like 15 or so. Yeah.
Yeah, exactly. I think, yeah, even large caps would work if you're pretty selective there. I think if you want to get over 20% CAGR over any significant period of time, like 1 to 3 to 5 years, you have to get out of large caps, in my opinion. But unless you're just really, man, if you know what you're doing for sure, yeah. But I would be pessimistic about my odds, honestly.
Yeah. That's hard. Yeah, just because it's just more efficient.
Yeah, too many smart guys looking at it.
Right. Yeah. Cool. Anything else you want to share or anything else you want to chat about that we missed?
I would say that, how do you feel about this recent, I don't know if it's recent, but my entire investing career, I have been walking into this group in investing circles that are just really focused on dividends.
Okay.
Have you run into that, or what are your thoughts on that? I think it's great.
Like dividend?
Yeah, like you only own a stock that has dividends that get paid out. They will sell a stock, cuts a dividend. Their whole investing strategy is this really bizarrely tax inefficient chasing of dividend.
Yeah.
I just, I've never been able to crack that puzzle.
Is that retail investors? Retail investors?
Yeah.
Okay.
I mean, even like look at like SDHD, where like there's a bunch of ETFs that very obviously cater to that demographic. And
Yeah.
exceedingly well, in my opinion.
Yeah. I don't know. I mean, most of my investing or like equity research is with people in the industry, and there wasn't a lot of income investors unless you were in credit. So I never really, maybe REITs was probably the closest that I saw people were into because they want the yield. But yeah, I don't actually know that many people who really focus on dividend investing.
Oh, okay. All right. Well, when you run into that crowd, I think you'll know who you're dealing with.
Yeah. Like they only want dividends. Like they're just mining stocks for dividends. That's basically it. Kind of.
It just seems very bizarre to me, and I just wish I understood it better because I don't even know what I'm arguing against. Because I feel like the argument against insisting on dividends at the exclusion of is a self-evident argument. Like they shouldn't have to get.
Oh, like people are like their priority is dividend. They don't care what the business is. Like as long as you can keep paying a dividend.
Yeah, because I'll run into retail investors where I'll be like, "Hey, I think this business could buy back. Does it pay a dividend?" It's literally the first question they ask. If the answer is
Interesting.
they don't care.
Interesting.
This mindset where they never sell, they hold forever, and they just collect it. And that is like bizarre to me because every single thesis I've ever written has had an exit. Whereas like the risk reward is shaded to the point where it's not even holdable. Like you have to sell.
Yes.
So, the fact that doesn't even exist for them, like that's also terrifying. Curious, like what this community form provably exists. What is driving it? And what is the philosophy and the rational argument behind it?
Right.
I just cannot find any online source or any person who can like clearly delineate what it is.
Well, it's two different approaches. Like what we're mainly talking about is pretty much making money from capital gains, right? Like the depreciation of the stock. Whereas I think for some people that's like gambling. It's like trading. So then that's what I assume. So then they can only think of in like getting income. like interest rates makes more sense than something appreciating in value.
Why wouldn't they just be into like the debt market, right? Like just find some good
right. So then why not just buy debt? Yeah. Or credit.
It just seems like the most inefficient answer to that problem. Because like, why are you yielding like 2 to 5% if you can get like 13, 14% and like
in the debt market,
get high junk rate, like corporate. Where
you
find the businesses that are low risk of default.
Yeah. I mean, if the company can grow its earnings, then you potentially could get like 5 to 10 in total.
I mean, over what time frame. I don't know. I guess
Yeah,
maybe
right. Yeah.
I'm just looking at it like if I deploy 100K into the market and I wait 20 years and I hamstring myself with the only dividends, like what does it look like exit inflation?
Yeah. The only benefit is you'll just get it versus like the S&P is you'll just get a coupon, I guess, like, cause you'll probably get like 8, 9% in yield and maybe 2 to 3 of that. And so you get like 2 to 3 in cash. Maybe that's as opposed to the S&P, you would never get any cash from it. Oh, you get like a 1 or 2%.
Yeah, the yield on that is tiny. I guess I
Yeah.
think do that if they're already in retirement or they need cash flow from their investment. Like,
Yeah. Cause it's like, that must be it. If you're like retiring, cause you're only looking at investments as an income source. You're not looking into grow.
interesting that they're because this, but I just margin. I just margin and everything. I just like put like I'm good.
Oh, you mean like you sell puts or you sell calls for income?
I like if I need cash for like living expense, I don't sell stock. I just take margin loan out and that
Oh, yeah, yeah, yeah.
just to protect the downsides on.
Got it.
And the net of all that is still like considering that it's tax free because it's debt. Like,
Yeah, yeah, yeah.
like,
Well, that's a pretty sophisticated strategy. I don't think even people are aware of that, that you can do that.
6 months on my brokerage account. It's not hard, but
Yeah, yeah. Right. Because you margin your equity so you can get cash and then you just buy a put just to make sure you cover your downside.
it's just I don't know. I feel like it's very obvious, very well known. It's not like I thought of it.
Yeah,
Everyone,
yeah, yeah.
I don't know. I just don't understand why that strategy never seemed to make it to retail. I don't know. It just but because I feel like that's
No, no.
something when they talk like a wealth advisor kind of thing
Yeah.
before them. But
Oh, well, I think, yeah. It makes a lot of sense, but I think it's difficult for a wealth advisor. Like, hey, just like borrow money off your stocks and use that to spend money,
I mean,
and then I'll just cover your downside with this option. People are gonna be like, "What?"
think so because if I walk into an office and I'm like, hey, I can bring you 8 figures. What is your strategy for like liquidity?
Yeah,
And they're talking something crazy like, oh, you sell X%. Good. Like, no, like, anyone can do that. That is very obvious. Like, it's usually what is the extra element that you bring in? I would think.
yeah, yeah, yeah. No,
Mhm.
that's a good point though, because I mean, think like rich people, like very wealthy people, like Elon Musk or Bezos. That's clearly what they're doing, right? They have no income source and they sell stock or they borrow debt on their stock to get cash.
And I was just really curious if now that you've kind of been like in the education space for a while, if you've run into that crowd or seen that kind of demand, but
No, not yet. I mean, I'm still more talking to people who are like, more in the earlier part. They want to grow as opposed to just get income. So I guess maybe from some of my friends who are just, like working and just investing for income. I guess some of them using, actually, not that many people I know do income.
I mean,
Maybe you just stumbled upon an income crowd.
Google it, man. I'm telling you, it's not a small crowd.
Yeah,
Some of the biggest finance content creators are completely
really. Okay.
branding for their channel. So it's just,
Yeah, yeah, yeah.
but,
Hmm.
but no, that's kind of the last thing I wanted to just kind of maybe touch on what pick your brain, what you're seeing. But, I'm very much a recluse. Like I don't really I don't write anymore. I don't write for value investors. I don't write for seeking out anymore.
Mm-hmm.
I don't have any presence.
Mm.
So I just do my own research and I talk to the peer group that I trust.
Yeah.
I publish a monthly newsletter for just friends and family. It just basically, I talk about it. I just cover the moves I'm making, which is usually nothing, just sitting on. I just walk.
You're like, yeah, go ahead.
No, I'm just saying, like I just try to make it very much just information for me, no recommendation.
Yeah.
I want to know if they buy it. Don't want to know if they sell. I don't want to know what kind of returns they get. Just
Yeah.
what I'm doing, and I know what kind of returns I'm getting.
Yeah. Because you don't want the responsibility of like managing a fund or managing other people's money, right?
With stress, I don't. So
Yeah. Yeah.
I'm with trouble learning how to manage my own money in terms of the emotional component.
Yeah.
Like, to ride downside, volatility, having conviction that I can write. I don't
Mhm.
think I'm wired to do it for other people.
Right. Yeah. It's definitely a different kind of beast. It seems like.
Well, yeah, no, that basically, that was the last thing I know. Obviously, I didn't get a question. I think we kind of,
I think we got through all of it. Yeah, no, that was really good.
yeah. The only other thing I had written down is kind of weird to just throw this in at the end, but did you want me to walk through an example where like it just totally did not work?
Sure. Yeah. Let's do that. Yeah. We can always throw that in.
Alright. And this is when I first started investing. So I got my nursing license May or June of 2015. First thing I ever bought was Starbucks. And we're talking like mid 2010 Starbucks. So this is when it was opening stores left to right, growing, launching proprietary branding, like in terms of like their take home coffee packs and all that stuff. So, business is firing on all cylinders. Right?
Yeah.
Be lazy. I did my due diligence using just historical numbers. I assumed that would pull forward for another 10 years.
Yeah.
I did my UCF and it did not. So what ended up happening is that stock moves just sideways for 3 years. And in June of 2018, I forget what quarter it is for their fiscal year, but they reported earnings and they're closing like 100 stores and nothing is selling, consumer back, competition. There's just a weak forecast everywhere. And their thing, like, that the management was pitching was that they had this product line, the Tivana refreshers. They're like, oh, I'm going to love this. This is what they're going to buy instead of coffee and sell this now. And we have an app. People are going to use the app, their stars, get loyal. Like, I was just like, oh my gosh, the wheels of this totally falling off this thing. So I sold, I think I was actually down, like 5%. I bought
5%?
2015,
Okay.
2018, 3 years, did nothing except pay a small dividend and, sold at a loss. That was like a great example of, I trusted this weird theory that if I use a product and like it, it's automatically within my circle of competence. It's not true.
Yeah.
That historical numbers will be a good predictor without any kind of further thought, which also is not true. And
Yeah.
I made the most classic mistake, which I think for newbies, which is a brand moat and you understand the brand moat and you trust it too much. So I was like, Starbucks is the premier like coffee shop and like it's everywhere. I see it everywhere. There's stores opening across the street from each other. Like it's crazy. And at no point did I think maybe that should have been a warning sign, not a bullish sign, that stores were opening across the street. Like maybe that was a business strategy. So
Got it.
In hindsight, I just wasn't doing the work. So
Yeah.
a good example of an investment where I essentially lost 3 years of market time.
Yeah.
5% of total capital. Just because
Yeah.
I just trusted random stuff that was low effort, easy to understand.
Yeah.
The work. So
Got it. So I guess what happened is I'm like trying to remember the story, but I guess, right, you bought it right when they were expanding. I was assuming that their multiple is probably quite high. The earnings expectations were right, 25. Earnings expectations are probably like 20% every year. You're like, okay, as long as I keep doing that, I'll be fine. Multiple compressed, earnings probably went down to 10% or so. And because they have all this expansion just took up all the margin and they weren't getting the same returns. That's kind of what happened. And I think this is before Howard came back, right?
Yeah.
Right. But you sold right when Howard came back.
This is like Kevin Johnson era. So,
Yeah.
Just that's for anyone listening. Yeah, those are the kind of mistakes I was making. I bought O2, like all kinds of just bad life choices. So
I hear you. I mean, yeah, sometimes. I mean, that's a hard thing to wrap your head around. I think in the beginning when you're first starting, it's like sometimes when something looks really good and everything's firing on all cylinders, it might just be the worst time to buy because it can't get any better.
Just really do your due diligence, guys. Just chew down to the bone on your thesis.
Yeah.
You got to really understand what every part of that business does, how it affects every part. So
yeah. And getting it into the numbers, I think is probably, because if you did that, you would have saw that, like at least your assumptions would have been too high or something like that.
Yeah, if I had broken down like same store sales, if I had broken down sales growth per region X expansion versus X new store count, if I had broken down geographic region performance, if I had put in some kind of estimate for FX headwind, all of this would have saved me. I did not.
Yeah. Like you would have seen that, like, it's really hard to get to those numbers, basically.
Yeah. Like they're telling me each new store has this revenue and I'm just going to trust it. And every revenue per new store is this anything.
Yeah.
Like the demand is going to be infinite. The TAM goes to the moon and like, no, that's just not how the growth works.
Right. Yes. 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 Got it. Right. They were entering saturated markets or something like that, or like they were just trying to expand in the U.S., which is like too much competition and stuff like that.
Mm. So you get just a good lesson for me and anyone else, just that you just really have to understand. It's very easy to think you do when you don't.
Yeah. It's not just like understanding the product or like you really like the product. It's a good starting point, but that's not a good thesis.
Yeah. But yeah,
I,
that's kind of it for me. So unless you had any
I think
points.
it's it. No, no, I think this is super useful. I think it'll be good for people to kind of hear from, I mean, you learned it all on your own. So that's pretty cool. Right. So most people
Well, I
don't
had
even,
some words that helped quite a bit with, especially
yeah.
with like stuff. I never read an ASC until they started
Never read a what?
an ASC, like the standard
Let's say
adjustment,
that.
like the ASC for like Gap, like the ASC.
Oh,
Yeah.
I don't think
Yeah.
I've even heard of that.
I think it was how an offshore oil helicopter company was capitalizing new aircraft, like
Yes.
with the amortization cycle. It wasn't
Yes.
not in the MD&A. So
Uh,
they pointed me towards that, and they're like, "Oh, this is how it's required to be done. You can read through it, understand like how it works.
oh, cool.
It is capitalized that way, kind of thing." So just because like sometimes capex is weird things. What was happening there was that technological advancements in aircraft technology had made it so that a cheaper aircraft could do the work of a more expensive aircraft from a decade prior. That's just,
Hmm.
that's says 20, 30-year asset lives. What's happening is that they were replacing their fleet with a different model of aircraft at a much better price point.
Yeah.
It wasn't flowing through correctly in terms of gap amortization because what was happening,
Okay.
instead of having like, you have a fleet and you're refreshing the fleet at this cost, what's happening is that the old fleet was being allowed to depreciate to nothing and the new fleet was being accounted for. And the interaction of that was doing wonky things to the rest of the cash flow. So I did not understand why some things were being amortized a certain way and why others,
Mm.
because like they were on two totally different schedules, despite them being essentially identical in terms of work. So,
Okay.
and I realized that that was just the gap requirement. The same thing happened with the software company where the way you have to amortize software services that are provided changed. So
Mm.
they had to restate all their financials and it was very Stanford. So just
Got it.
stuff like that where like, so having that kind of mentorship helps. But,
Yeah. So basically talking about like, okay, modeling like depreciation and amortization line. It's just like, it doesn't really make any sense when you're like trying to go forward.
a
Yeah.
lot of that forces the company to report something a certain way, even that doesn't really make sense to.
Yeah.
Or like if a certain product or a certain business segment is X% of total revenue has to be broken out. But sometimes having it broken out is very confusing because it's part of an ecosystem of SG&A.
Okay. Yes.
Towards the entire business, but now they're forcing them to kind of cost attribute to certain segments.
Mm.
Stuff like that can be tricky. So like sometimes it's actually better to undo gap and put the business back together.
Right.
And, just like little things like that, it helps to have mentorship. So that's why I only hesitate when you say like I did it all on my own. 'Cause I don't feel like I did.
Yeah. That's pretty intricate stuff. Yeah. Cause you're like really getting into the right depreciation schedule. Right. That's pretty tricky. That's like what bankers do. I think I don't, yeah, I think I've definitely dug into, I think I've wrestled with 10Ks trying to figure out depreciation schedules, but I never looked into the ASC. I might need to look into that. You know what I mean?
I don't know. I think every year they update at least, or they say they're not going to change it.
Yeah.
But 'cause if you get too far into the accounting weeds, what can happen is that you start seeing shadows where they don't exist. Like,
Yes.
oh, this number looks funky, or the accounts receivable is growing. What's happening there? Kind of thing. You can really spook yourself out of an idea.
Yeah. I try to keep it high level usually. I usually don't mess around with those kind of things too much. Unless something looks really off.
Yeah, it can be bad if you get too far in there. But
You start to see like,
yeah,
like there was like someone on Twitter was like, oh my God, like their accounts receivable went down. Like there's channel stuffing or something like that. There's someone on Twitter, which is just dumb. I don't know. They're like, there's no reason gross margin should be so high. Like, I think you're just reading into the receivables too much.
yeah. People really like to really pick apart working capital. Sometimes it's useful, but a lot of times it's not.
I've never found picking apart working capital to ever been useful in my entire life so far.
Few key examples are as useful for me, but
Yeah.
mostly 95% of the time it's always.
Yeah.
The only time it was useful, the first time was I was in a retail stock and they were doing last in, first out accounting.
Oh, yes. Okay. Yeah. Yeah.
So their working capital was looking really crazy, but I knew
Mm,
that full free cash flow to the business, despite what they're reporting in GAAP numbers, was actually positive. So,
got it.
but just because of stuff like that, where I knew that they would still be able to maintain their share repurchase and their debt covenant,
Okay. Yeah.
short this stock based on just those numbers, and I knew
Yes.
enough to go along. Uh,
Yeah.
just
Yeah.
stuff like
Yeah.
that.
Yeah.
I can't remember the other one. I think the other one was kind of similar. Oh no, it was that software company where
Okay.
just the way that they were putting in the acquisition, they were using the cash from operations to fund more acquisitions on the other end. But the way they were accounting for it was kind of weird because it was a Canadian company.
Mm.
TSX, man, I don't know why I own Canadian companies. Sometimes. Just like look into them, but yeah, I remember that it was helpful there just to look at working capital to actually put it together. But
Yeah. Because they just reported it differently.
I agree. It's one of the worst places to put your effort, mostly.
Yeah. Cool, man. All right. Well, I think that's it. Well, yeah. Thanks for, I think this was great. Thanks for a great conversation.
All right, man. Well, best of luck. Godspeed. Think your work you're doing could be incredibly important.
Yeah. Thanks.
If people really take it seriously.
Yeah. Hopefully I hope to create more like stories like yours. Um, yeah. And if there's like people that you know that you think would be a good fit, just send them my way and I can maybe see if I can help them out
Yeah, some
with the course or the product. Cool. Well, yeah, good to chat, man. And let's stay in touch. If you have anything you need, just let me know.
good one.
All right. Cheers, man. Have a good day. Bye.